In this lesson, we will talk about the expense classification and its legal significance. Accurate expense classification is not only fundamental to sound accounting, but is also a legal requirement. Misclassification can result in severe regulatory, financial, and reputational consequences for organizations. Expense categorization involves systematically classifying costs according to their nature, function, and timing, following established accounting standards such as GAAP and IFRS. Legally, proper expense classification is crucial for tax compliance, financial reporting accuracy, and regulatory oversight. Misclassification, whether intentional or accidental, can lead to penalties, restatements, and even criminal charges, making robust internal controls and documentation essential for legal compliance. Expense classification follows core accounting principles to ensure accurate financial reporting. Categories include operating expenses, e.g. salaries, rent, non-operating expenses, e.g. interest, write-downs, direct expenses, e.g. raw materials, indirect expenses, e.g. utilities, fixed expenses, e.g. rent, and variable expenses, e.g. sales commissions. The matching principle ensures expenses are recognized in the period they generate revenue. Materiality and consistency require separating only significant items while applying methods uniformly. Finally, classification must reflect the economic reality, adhering to the principle of substance over form. Deductible expenses under U.S. tax law must be both ordinary, common in the industry, and necessary, helpful, and appropriate, with the IRS distinguishing between business expenses, capital expenditures, cost of goods sold, and non-deductible items. Detailed records such as receipts and invoices are required to substantiate deductions. SEC regulations mandate that public companies classify and disclose expenses per U.S. GAAP, provide detailed breakdowns, and disclose material items, while the Sarbanes-Oxley Act requires robust internal controls over financial reporting, including expense classification. Internationally, IFRS requires classification by nature or function with enhanced disclosure for significant items, and EU directives mandate clear categorization and disclosure financial statements. Expense classification is governed by strict legal and regulatory frameworks across U.S. tax law, securities law, and international standards. Deductible expenses under U.S. tax law must be ordinary, common in the industry, and necessary, helpful, and appropriate, with the IRS distinguishing business expenses, capital expenditures, cost of goods sold, and non-deductible items. SEC regulations require expense classification per U.S. GAAP, detailed breakdowns, and material disclosures, while the Sarbanes-Oxley Act mandates robust internal controls. IFRS requires classification by nature or function, with EU directives mandating clear categorization in financial statements. Compliance best practices include implementing internal controls such as COSO frameworks to ensure reliable expense classification and prevent errors or fraud. Maintaining comprehensive and accessible records for all expenses, including the rationale for classification, is essential. Audit committees should regularly review controls, challenge management on risk areas, and address deficiencies promptly. Fostering a culture of compliance through regular training, strong governance, and updated policies helps organizations stay prepared for evolving risks. Legal consequences of expense or worker misclassification are severe, including regulatory penalties, criminal liability, and reputational damage. Notable cases include WorldCom's expense fraud, resulting in a 25-year prison sentence for the CEO Waste Management's earnings inflation, leading to $132 million in fines, and AOL's improper expense capitalization, with a $300 million penalty. Worker misclassification cases such as Uber, Lyft, and FedEx resulted in settlements exceeding $175 million and operational changes. Misclassification risks fines, felony charges, and stakeholder trust erosion. Legal definitions of expense types include ordinary expenses, which are common in the business's industry, and necessary expenses, which are helpful and appropriate for operations. Capital expenses provide benefits beyond the current year and must be capitalized. COGS covers direct production costs, while non-deductible expenses are personal or not business-related. To sum up, expense classification is both an accounting necessity and a legal obligation. Proper categorization ensures compliance with tax laws, securities regulations, and international standards, while misclassification exposes organizations to significant legal, financial, and reputational risks. Robust internal controls, thorough documentation, and proactive governance are essential to minimize risk and uphold legal and ethical standards in financial reporting.